here are three scenarios that a lot of investors trip up on in terms of how to value the property. Okay, so scenario number one is you're buying a vacant property. Okay, so there's no income. So how do you value that property? Okay, so going back to the four methods, the cap rates, the sales comparables, the DCFs, and the replacement costs. If it's a vacant property, well, which method should we use?
I would use a comparison method and then discount how long I think it's realistically going to take to fill it, and the cost of that, and the incentive for it. So a combination, I guess.
Yeah. Okay. Yep. That's a really good one. Anyone else?
Depends on location a little bit.
What do you mean?
Like if you have a very rural property, you might not have a lot of comparable sales. You might not be a lot of data you can look at. So at that point, you might look at the replacement costs. Like, is it plenty of land available? So what would it cost someone to just buy land and build is something that's very similar. Whereas in a central location, we looked at one, Newcastle, for example, there's a lot of properties around it. You can say, these many properties got leased in the last 6 months. We expect these to lease in the next 4 months. These are the last leases. These are good comparable. So I think it depends a little bit.
Yep.
That's more hypothetical of what you're going to get more than replacement, because I used to see in the country towns, so that you could buy buildings that would cost $1 million to build, but buy them for $200,000. So the replacement cost didn't
stack up.
Yeah.
So that's why there's four methods,
Yeah.
right? Because one of those methods, like you said,
Yeah.
wouldn't be applicable for that scenario.
Yeah.
Yeah. But let's say it's just a pretty sort of standard sort of commercial property. Let's say it's a metro area, but if it's vacant, mine says comparables, so comparable sales. Anyone else?
I think you could guess what you're probably going to rent it for, and then adjust it back because it's not rented.
Yep. So how will that math work?
Well, I think based on comparable leases, you sort of say, well, what are we likely to get, and then you just got to apply some sort of discount because it's not, and how long it's going to take potentially to find a tenant, I suppose.
Yeah. So that's a really good excuse me, scenario. So I'll give you guys the answers. So there's probably two ways, right? So the sales comparable, yep, that's a pretty foolproof way to do it. It's a vacant property, it's 1,000 square meters. What did the property next door sell for? It sold for $2,000 a square meter. All right, well, that's probably comparable. And then the other way, which is what Patrick is saying, is what can I get potentially for rent? Use a cap rate to work it out, and then minus the cost of leasing.
Yeah.
So in a perfect world, that should line up.
So the other extra would be if it's got development potential.
Yes, so you can factor those elements in as well. Yeah. So no two properties are actually identical in most places, right?
And you need to be a little bit careful of the sales comp thing as well, because if that vacant 1,000 metre industrial building sold to an owner occupier who has no leasing risk and can afford to pay a premium, as opposed to an investor that's got to factor in the reletting. So depending who bought it, as to whether it's sold at a premium price to an owner occupier or to an investor who's then got to find a tenant, can make a big difference in how relevant that comp is to what you're planning on doing on building next door, the same size.
Yeah, so that's a really good point. So understanding the market will then allow you to work out which one is more relevant. Obviously, we'll get into the market side of things later on, but Wally made a really good point, because in most circumstances, owner-occupiers will pay more than investor because they don't have those costs, those leasing costs and all that type of stuff, right? Same with residential. Investors will pay less than an owner-occupier, right? So understand what the market that particular property sits in. Is it an owner-occupied dominated market, or is it an investor-dominated market? That's really important to understand as well. And then also price bracket too, right? Because most owner-occupiers, they tap out after a certain level in certain markets. Like for example, in Sydney, owner-occupiers might tap out after $15 million, right? And then in Melbourne, it might be 10, in Brisbane, it might be a little bit different. So understanding those little sort of nuances will help. But if all things are equal, then vacant property, yeah, I'll probably use one of these two methods. And I'll probably use both and see if they line up. If there's a gap, then I want to work out, well, where's the gap? Why is there a gap? That's the easy one. Hard one, in the middle. Inflated net rents. So let's say the scenario is, I'm an occupier. I've decided to sell the property because I want the cash to do whatever I want. But I'm a little bit sneaky. I'm going to lease it back to myself at 10, 15% above what the market rent is. Let's say the market rent is $200 a square meter. I write a lease to myself for $220 a square meter. And I offer it to the market, and I'm saying this property is worth 5% cap rate. Then how would you guys then work out what the valuation of the property is? Because don't forget, again, assuming everything's equal and I'm going to honour my lease for the next 5 years, I'm paying you 10% more in rent. So how did you value the property? What would you do in that scenario?
You'd probably have to discount back to work out what the actual is, and then apply something for that extra that you've got, I would think.
Yeah. So okay. Here's a scenario. Let's say the cap rate is 5%, just for easy math, right?
Yeah.
Let's say all things equal, it's a 5% cap rate for that property. Market rate is $200 per square meter, but I'm leasing it back to myself at $220 per square meter.
So that you'd have to value it at 200 a square metre.
But I'm paying 10% more in rent.
Yeah, then you've got to allow a bit for that, don't you? Because the reality is, once it gets to the end of the lease, it can revert to market.
But I'm still giving you an extra 10% for the next 5 years. So
I don't know how you value that extra bit, but
A value would do no more than just add it on as an amount for 5 years, I would have thought.
yeah, maybe. But if you as an investor, how would you?
Oh, I think I'm on the same page.
I reckon the safe
I'd
bet is to
work it back to market,
You get
add
nothing
on
for that.
5 times 10 grand, whatever the extra is.
Yeah. Yeah.
Because that's where you're going to end up in 5 years' time, back to market.
Anyone else? So
Yeah, I think, give them that. I had a scenario, I was looking at a property, and it was a main strip of a regional town, and it was the owner selling, it's like a reject shop style concept. But I could just tell that they were going to get out of the business, and they'd pumped up the rents, and so I didn't proceed. And 4 years later, the shop's shut, it's just sitting there vacant, they never sold it because no one. But it was a similar sort of scenario, and I just felt like, no, you don't get anything for that. I think that's the safe position to take.
okay.
I think.
Yeah, you're probably right. But in this scenario, let's say like I'm BHP, right? I'm BHP. I used to own this $30 million property. Now I don't need it because my business case is, has shifted, and I'm paying 10% more.
Is it case-to-case basis? I mean, like if someone had just signed 10-year lease a month ago and just trying to sell it now, and you're like, hey, that's over market rent, there's something shifted going on. But if they've got a 10-year lease, but they're on year 6 and trying to sell, I just say, well, you bear that cost for a long time. That's probably not something shifted going on. The market maybe have changed since that time. Isn't it the best thing just look at comparables and bring that data to the seller and say, look, but I'm not just selling for this, but this is what the market is currently doing. This is what I'm prepared to pay.
the debate's only on the extra, isn't it?
Yeah,
Because
sure.
we're bringing it back to market, so that we probably all agree with that methodology. We just need the answer from you on what you pay for the extra.
They're also bringing you a slightly better finance solution too, which I don't know how you factor that in. But if you take that to the bank and the bank's not aware that it's 10% over, you're going to get a beneficial finance solution. If you're aware, you'll end up back in 5 years' time down the market. So I don't know how you factor that in either, but there is actually a bit of banking helping what they're doing.
Do you? I don't know, is that true?
Is it?
Do the banks, when they value it, they'll go and value it and say it's above market rent? Don't they?
Well,
They use a method called term and reversion. So they do value the term, they discount it,
Right,
it's a future cash flow, and they revert it back to market, what market rents would be. So they do both.
right.
It's a quite technical calculation they use, but yeah. So often the term is not that much of an issue or a discount. It normally just ends up quite close to the market, but that's the official way of doing it.
okay. So I think we're all
Very keen for the answer. Tell us what. We guessed out.
Okay. Well, I think it's all case by case, but I will be doing exactly what you guys are saying. I will be working out what the actual market rent should be for that property, and then apply that appropriate cap rate to the market rent, and then the surplus, I'll be looking at the strength of the tenant who's staying. And you know, if they're fair income, right, then I say, oh, well, you are giving me a 10% premium. I might be earning an extra 50 grand across 5 years. Great. Maybe I'll pay an extra $50,000 on a price, maybe. You know, so I might factor that in.
What if you're investigating capex? Just say, I make your building for the next 5 years look much better.
Sorry, say it again.
So you take the surplus, you say instead of me pocketing it, I invest that into the building and make it look much better for the next 5 years that you are here. So you benefit of having a nicer presentation, and I benefit from having a nicer building once you leave.
Well, I mean, yeah, I mean, certainly that could be a conversation, but that's a separate conversation to
The valuation.
to what we're trying to work out.
Yeah.
But yeah, I mean, that's thinking outside the square. So that's what I would do. I would revert it back to market rent, work out what the market cap rate is for that type of property. That's my base. And then that surplus, then I work out, well, what's the strength of the tenant? If the tenant's fair income, and I'm getting an extra 50 grand over the next 5 years, maybe I pay him 30 grand more for the property. Yeah. So that's what I would probably do. But it really comes down to the valuation. Because if the valuer, which I think is going to be rare, if the valuer does adopt the higher rent, then yeah, you can probably potentially borrow more money. That kind of improves my investment case.
They often do as well. They often go in there and completely misread the market.
Especially third party valuer at a lower property. They're not going to borrow.
Yeah, so that's an interesting idea, right? So food for thought.
Do you come across that much? Tenants cranked up the rent to get out? Like, did you reckon that? I mean, I'm aware of it, but I wouldn't have said it was common. You guys reckon you see a fair bit of it?
A fair bit,
Yeah.
not all the time.
Often with the lease back, they can undercook it,
Yeah.
which is detrimental to themselves.
Yeah.
Completely. When it's like a later party lease back.
Yeah, which is the third one which I want to talk about is what it's probably under rented. How do you then value that property?
That's the opportunity, isn't it? Isn't that what we're looking
call
for?
you.
I think that's why we're here. But this is a very important exercise because now, same scenario, okay. Let's say the market rent is $200 a square meter, and I'm leasing it back for 150 because that's all I can afford as a business owner for my business. But the market rent's 200. Then the cap rate's 5% for the market. How do you then work out the value? Do you apply 5% on the $150 a square meter, or do you apply 5% on the $200 a square meter? What would you guys do? See?
So I think we should do 200.
Right.
5%.
Okay.
But what you will be getting is $50, right? So $50, so 150 versus the 200. So you want $50, and when you just calculate 5%, then That's that, how much average you will get.
Yeah, so the question is how much would you pay for that property? Right? So if it's $200 a square metre, market rent, I'm only paying 150 and the cap rate's 5%, well, what would you pay for that property on a per square metre? Anyone else?
Well, I think that you again got to go to market rent, but you in negotiation you're trying to work on the undervalued rent, aren't you? From a valuation perspective, in your mind you're thinking, well, it's really worth X if it was at market, and I get the chance to put it to market at whatever point. From a negotiation point of view, you're trying to use that to negotiate down.
Right, yes, absolutely. But the question is, what would you pay for it? Okay, so remember there's 4 valuation methods. Okay, so the cap rate method probably is not going to work. Or will it work?
Well, if I'm going to.
What is the lease?
Yeah, it'll work if you adjust it.
Yeah, that's a good point. That's a good
Well, I'd
point.
say the cap rate method would give you the 2 spreads of what you'd love to pay versus where you're getting out. And then you've got to work out how much of that you're giving away to end up with it.
Great answer.
That's
Yep.
my logic.
Yeah. So I think best case scenario, with us saying, is you want to buy it for 5% cap rate on the 150, right? Because then you've got the arbitrage.
Yeah.
Once you do the uplift. But the market's very efficient, okay? Because you may not be the only buyer on that property. And then, so someone else might say, you know, well, I'll pay 5% on $175 per square metre and things like that. So that's why very often when we find properties that are under rented significantly, we're going in a much lower initial yield because the market understands the market is very efficient, and most investors can see that, at least if they know what they're doing. So that's again a very tricky one because it's under rented now. What's a fair value for property? Well, the fair value the argument could be, well, we should use the sales comparable method or replacement cost method, and we'll throw cap rate out the window. But then the counter argument is, well, I've got to borrow money from a bank, and the bank's going to look at the income. So most of the time you're balanced the two, and sometimes we can meet in the middle. In some cases where we're lucky, we can buy it for the market cap rate at the lower rent, and that's where you get the maximum uplift. Make sense?
How does that affect your borrowing
Well, the bank would only borrow off of income,
on the lease that's there?
the guaranteed income, right? So the bank's not gonna,
You have to put more equity in.
you're gonna put more equity in, that's right. Yeah.